Welcome back to the channel. A lot to unpack, a lot to talk about this week. Going to focus in on interest rates. What are the most current interest rates right now that are being offered? Are they applicable to you and your financial situation when it comes to your mortgage? And what things should you be paying close attention to when looking at these mortgages, especially for those that are approaching mortgage renewal in the next little while, what you should be doing and what those rates should look like. So we'll go through all that this week. So once again, we welcome you back to the channel. If you have not subscribed, want to stay up to date with everything that's happening, especially in the mortgage and real estate marketplace when it comes to interest rates, well, make sure you subscribe to the channel. Don't forget to hit that notification bell, as well as let us hear from you in the comment section below, your thoughts, questions, and concerns as we read each and one of these comments. So ultimately right now, you're looking for a mortgage rate. You might be shopping for a mortgage renewal. You might be a new buyer looking to get out into the market, what you should be expecting at this current point. You know, maybe you're looking to refinance or restructure. Maybe you're just starting that journey, not sure where to be or what things should look like for you. Ultimately, right now, we want to provide all our viewers, especially our clients, with this information as they are approaching us with their options when it comes to mortgage renewal. And looking online, a lot of times we get presented with particular offers from lenders and banks and brokers online. We do have access to all the discounted rates, some of those that are not even published on the internet, especially those that are published on some of these websites. These are super important products, but most of these lower rate products are geared and specified for high ratio insured mortgages. So what does this mean? A high ratio insured mortgage means that you are buying a home, right? These are designed for purchases. You're buying with less than 20% down, which means you are paying a default insurance premium to one of the three major insurers in Canada, whether that be CMHC, Canadian Mortgage and Housing Corporation, Sagan, or Canada Guarantee. There are premiums based on the size of the purchase, and these are things that you have to keep in mind. You're trading a discounted rate for a premium that's being tacked on to the back end of your mortgage, and then you'll be paying the tax component at closing. So ultimately, these are geared to these buyers, and a lot of times when clients are presenting us with these offers, you know, you're looking at it, you're clicking on it saying, oh yes, this is for a high ratio purchase. Now, although those ratios, those particular high ratio mortgages have a discounted rate, for some clients, they may be able to obtain a rate that is generally about 10 to 15, maybe 20 basis points spread from that rate depending on the lender. Now, why is this super important to understand? And we'll discuss the rates. I'll showcase them for you in just a moment. But ultimately right now, what you need to understand is some of these offers may be from broker exclusive banks. We call them monoline banks, is all they do is offer mortgage components, but they may not have other bells and whistles that you may be looking for in a mortgage or planned for in a mortgage, such as getting access to a line of credit. Maybe if you want a home equity line of credit, maybe you're putting a large chunk of money down, maybe you're renewing your mortgage, you've built in a lot of equity, and you want to have access to that equity. You don't necessarily want to pull it out in the sense of a refinance to get that money out, start paying interest from day one. You may have some projects lined up down the road. This is where you really need to consider your options and understand what it is that you're looking for in your next mortgage product. So understanding that there are products that are designed for purchases with less than 20% down. And just to recap very quickly, some of those changes have been moved, or the needle had moved back in December. You may or may not be aware that now, as a first-time home buyer with less than 20% down, you have the option to take a 30-year mortgage, where you didn't have that option before. You could only take 25, and that is geared only and exclusively to first-time home buyers. If you're deemed to be a first-time home buyer, which means you haven't owned a home for around 4 years, you are going through a divorce or separation, and ultimately there are some specifications for that. But you still can buy a home up to 1.5 million. Now, you don't necessarily have to be a first-time home buyer to buy at 1.5 million. You could have owned a home and you sold it, and now you don't want to put 20% down on the next home. You want to buy up to 1.5. You can do so, but you just can't take the 30-year amortization. You have to take the 25. So these are some interesting tidbits. If you have any questions or are looking at your option, obviously feel free to reach out to our team here at In Touch Mortgage Solutions. we'll be more than happy to walk you through the process. Now, the other thing when shopping online, obviously, is understanding, is this a switch or transfer? Are you just moving from lender A to lender B? And are you not asking for new money? Some lenders do charge a premium. The rates may not apply, especially when you're approaching mortgage renewal. What we found with some of the clients is if they're going in, they're getting a rate, but they're saying, Ant, I want to consolidate, I want to pull out some equity, I want to re-amortize back up to 30 years. There might be a whole bunch of things that are happening within that mortgage that doesn't allow that rate to actually apply. Now, that is super important. Not saying that it happens at all times, but some banks may not have that particular option. You may have to go through a refinance, break the mortgage early. Hopefully you're not doing that. You're waiting right till your mortgage expires, especially if you have a super, super low rate in comparison to where rates are today. We're telling our clients, don't break out of that mortgage early unless it's a necessity. You need to do it for whatever financial reasons that you may be going through. But if you can wait and hold off, you can keep some more money in your pocket and you can go through the whole process once you are what we call a free agent with the bank. You can switch in and out of that lender. There are lenders that offer super aggressive packages to help you pay for some of those things like the appraisal if it's required. You can also get some cash back. You might be able to get even coverage on, for example, the discharge fee, the transfer, to use the bank's internal system to do the closing. Generally, these are done through companies like First Canadian Title, for FCT, for example, and they basically do the whole legal transaction with you actually having to hire a lawyer. So these are super important things that you should be considering. Another super important thing is when you get that mortgage renewal, if you're approaching mortgage renewal in 2025 or even 2026, is making sure, obviously, number one, your taxes are up to date as we approach, now that we're into February, a lot of clients are going to get their T4s. Keep those handy, especially if you're looking to restructure. Remember, on a renewal, you do not need to generally actually apply again for the mortgage, right? If you're staying with the same lender and you're signing back, it's basically signed, sealed, and delivered. Just make sure you're negotiating with your lender. Don't always accept the first offer that is being presented to you. A lot of times clients will just accept that offer at face value without reaching out to us or having that conversation. Sometimes there's something we can offer or present to you that might keep more money in your pocket. So always understand and make sure to diarize your renewal. Once you get that mortgage, don't let the bank be the one that's notifying you. Put a reminder in your calendar. There's no excuse with technology today not to be able to set a reminder 6 months, 3 months before that mortgage comes up for renewal, because sometimes the banks may not reach out to you right away. They'll wait right to the last minute if they even reach out to you, and then you don't have that time to actually start shopping for a product. Let's get into some of these actual interest rates. Now, some of the most popular products right now are obviously things that we've discussed, are the 3, the 5-year fixed and those 5-year variables. Those are generally the most common products right now. Ultimately, for some Canadians, variable may not be an option. They may have gotten burned or felt that, hey, variable is not something that is in my risk portfolio. I'd rather get a fixed rate mortgage as opposed to variable. And then there's clients that are on the opposite side. Hey, we think the Bank of Canada is going to be super aggressive cutting rates, and we're okay to expose ourselves to a little bit more risk in order to potentially see some savings down the road. So these are some important things. So understanding 3-year insured mortgage, which is basically you're putting less than 20% down. Remember, those are the key. 3-year fixed mortgages, we're seeing around 389 to 399 for that particular 3-year fixed insured. Generally, if you're getting a conventional where you're still getting that 30-year, but you're maybe buying, maybe you're restructuring or refinancing, renewing that mortgage, you may not see a rate with a 399 or 389 in front of it. You might be at 409 to 419, depending on the lender and obviously what options are available with that particular lender. So a 5-year fixed right now is also hovering in and around the low 4%. We're seeing them similarly, in that 389 to potentially 409 for a 5-year fixed. As we look at the bond yields, what's happening in the bond market, ultimately those are pricing in potentially a little bit higher. We may see them come down. Remember, a lot of banks have not generally moved their rates down just yet. Remember, they're looking for that sustained lower yields in those bonds that allows them to actually drop their rates and hold them there. So super important to understand, you should be basically in the low 4s, if not below 4% for an insured, an insurable, and what we call a conventional mortgage on those 3 and 5 year products. If you're looking at a 5-year variable, those are generally the ones that come with that discount. Remember, there's prime. Right now, as of January 29th, prime has moved for the major banks down to 5.20%. Bank of Canada cut a quarter, policy rates at 3%. So generally right now, prime, which is most lines of credits, are hovering at a 5.20%. From that, on a mortgage, you might see rates that are around prime minus 1% or more, 1.1, 1.05. Basically, 4% mark, potentially, or in and around that 4% mark, I should say, for an insured, less than 20% down, buyer with that default insurance premium, you're gonna see those heavy discounts. At renewal time, you may see some of those lenders are not as aggressive, right? That rate may not be as aggressive at prime minus 1 or 1.1 or 1.05, depending on the option. Basically, right now, you're looking at prime minus 50, 60, or 70 basis points. Some of them are even at 80 basis points for a conventional versus an insured mortgage that might be at prime minus 1 plus, right? So understanding that now, a lot of times when you're looking at these products, it's super, super important to understand what type of lender you are working with. Variable does, yes, give you the ability to pay a 3-month interest penalty, interest-only penalty. That does vary from some banks, like lenders, top-tier banks, to potentially broker-friendly banks that may calculate them differently. But you do have to understand that some of those banks may not offer you line of credit, which means you have to break the mortgage and move your mortgage into that lender, which eventually could cost you thousands of dollars. So planning ahead, especially if you're approaching mortgage renewal, if you're approaching, a switch transfer option, understanding those particular nuances. Another thing we did not mention earlier on, so just to backtrack a quick second, for clients that are just doing a straight switch transfer from basically federally regulated banks like your top 5 to another top 5, you don't necessarily have to undergo, you shouldn't have to undergo the stress test. Now, if you're coming in from, and the reason why I say that is because if you're coming in potentially from a broker-friendly bank that is not federally regulated, you may still have to undergo the stress test. Some banks have decided that they still want to complete the stress test on mortgages. They still want to underwrite the deal as, contract rate plus that 2%, just for their own book of business. Once again, this is something you have to pay close attention to. If you have questions, if you're not sure, reach out to an in-touch mortgage professional, reach out to your lender, reach out to your broker to find out more information about what these particular changes, what bank you're with, what bank you're thinking about going to, or just really pricing out your options. What generally, you have to be very cautious. There always are strings attached with some of these mortgages, especially when you think about some of these lower rate end mortgages. Maybe you're with a bank, maybe you're with a broker-friendly bank, maybe you're looking to switch. Some of the banks, some of the major banks, they may offer, as I said, cashback options if that's applicable. Maybe they are offering you the ability to switch at a discounted rate, but you need to open an account. You need to have some products with them, whether that be an account with overdraft protection, getting a credit card, or an unsecured line of credit. Depending on the product, they may give you a better rate if you decide to open an account with them. Remember, mortgages are profitable, but not as profitable as generally day-to-day banking accounts, and the ability for these banks to cross-pollinate, sell you other particular products like mortgage insurance, lines of credits, basically debt instruments. So these were some of the rates. Once again, if you have questions about them or we didn't discuss a rate that you were considering, feel free to reach out to our team here at InTouch Mortgage Solutions. We can help you out, or you can download our free app in the description box below, and that can help you calculate some of the rates that we have that are being accessed right now by our clients. And it gives you a better understanding with all the tools and calculators in there, what your payments could look like depending on what you want to do. But once again, do you think interest rates are going to continue to drop? Are we going to see them level off, or even fixed rates go up, depending on what's happening with the US, right? These tariffs. So let us know your thoughts in the comments section below. And keeping in mind a couple other extra points, we do have CPI data coming out next week on February 18th. And we have the Bank of Canada meeting on March 12th. If you want to stay up to date with what's happening in those particular news segments, what's going to happen with those press releases, make sure you're subscribed to the channel. We update our clients every single week. But until next week, thanks for stopping by, and we'll see you again.